The Das pulls out of his hat this time around. He's on your screen right now.
Namaskar. We are now into the 8th year of our monetary policy making under the new inflation targeting framework. If you remember, this was started in October of 2016. So 7 years are complete. We are into the 8th year. And on a personal note, if I can seek your indulgence, this would be my 32nd monetary policy, including the off-cycle meeting last year and a special meeting. And at the outset, let me also wish each one of you a very happy new year in advance. And this is how the statement reads. As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available which I have put in the footnote, so those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24, primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October, with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation in core gathered momentum during September-October and reached levels last seen in the fourth quarter of 2019-20 due to the combined effect of policy rate increases and reduction in cost push pressures across core goods and services. Going ahead, inflation outlook would be considerably influenced by uncertain food prices. High-frequency food price indicators point to an increase in prices of key vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices, and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by the government are also containing domestic food price pressures. Crude oil has softened considerably, though it may remain volatile. Taking into account these factors and on the assumption of normal monsoons, CPI inflation is projected at 5.4% for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first three quarters of next year, CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply-side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply-side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to Marginal Standing Facility, that is MSF, by the banks. In parallel, utilization of Standing Deposit Facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system, and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macroprudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. On the financing side, foreign portfolio investment, that is FPI flows, have seen a significant turnaround during the current year, with net FPI inflows of US $24.9 billion up to December 6, as against net outflows in the preceding 2 years. Net foreign direct investment, that is FDI, on the other hand, moderated to US $10.4 billion in April-October this year from US $20.8 billion a year ago. Net inflows under external commercial borrowings, that is ECBs, and non-resident deposit accounts are, however, much higher than last year. India's external vulnerability indicators exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period. India's foreign exchange reserves stood at $604 billion as on 1st December 2023. We remain confident of meeting our external financial requirements comfortably. I would now like to announce certain additional measures. First one relates to review of regulatory framework for hedging of foreign exchange risks. The regulatory framework for foreign exchange derivative transactions was last reviewed in 2020. Based on market developments and feedback received from market participants, the extant regulatory framework for forex derivative transactions has been refined and consolidated under a single master direction. This will further deepen the forex derivatives market by enhancing operational efficiency and ease of access for the users. The next announcement relates to framework for connected lending. The extant guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by the regulated entities. The next announcement relates to regulatory framework for web aggregation of loan products. The Reserve Bank had introduced the regulatory framework for digital lending in August-September 2022. The digital lending ecosystem also comprises of services that aggregate loan offers from various lenders, and this is called web aggregation of loan products. Now, this is meant for the guidance of the customers. It enables the customers to decide which loan product to opt for. Several concerns relating to such web aggregation of loan products which harm consumers' interest have come to our notice. It has therefore been decided to lay down a regulatory framework for web aggregation of loan products. This is expected to result in enhanced customer centricity and transparency in digital lending. Next announcement relates to setting up of a fintech repository. Financial entities like banks and NBFCs in India are increasingly partnering with fintechs. For better understanding of developments in the fintech ecosystem and to support this sector, it is proposed to set up a fintech repository. This repository will be operationalized by the Reserve Bank Innovation Hub in April 2024 or earlier. Fintechs would be encouraged to provide relevant information voluntarily to this repository. The next announcement, there are two announcements relating to UPI. The first announcement relating to UPI is for enhancing the UPI transaction limit for specified categories. The limit for various categories of UPI transactions have been reviewed from time to time. It is now proposed to enhance the UPI transaction limit for payment to hospitals and educational institutions from rupees 1 lakh to rupees 5 lakh per transaction. This will help the consumers to make UPI payments of higher amounts for education and healthcare facilities, for education and healthcare purposes. The second announcement relating to UPI relates to, it relates to e-mandates for recurring online transactions. It's actually, it's a much broader announcement. It relates to e-mandates for recurring online transactions, and specifically it focuses on enhancement of limit for specified categories. E-mandates for making payments of recurring nature have become popular among customers. Under this framework, an additional factor authentication is currently required for recurring transactions exceeding rupees 15,000. It is now proposed to enhance this limit to 1 lakh rupees per transaction for recurring payments for mutual fund subscriptions, insurance premium subscriptions, and credit card repayments. This measure will further accelerate the usage of e-mandates. So strictly speaking, this is not a part of UPI alone. I mean, it's a wider, it has got wider ramifications. And the last announcement that I have, it relates to establishment of a cloud facility for the financial sector in India. Banks and financial institutions are maintaining an ever-increasing volume of data. Many of them are utilizing the cloud facilities for this purpose. The Reserve Bank is working on establishing a cloud facility for the financial sector in India for this purpose. Such facility would enhance data security, integrity, and privacy. It would also facilitate better scalability and business continuity. The cloud facility is intended to be rolled out in a calibrated fashion over the medium term. I would now like to conclude. In a global economy clouded by uncertainties, monetary policy actions and communication can be a stabilizing force by anchoring the expectations of economic agents. Clarity and consistency in action and communication is a time-tested principle for effective monetary policy. Policymakers have to be mindful of the risk of being carried away by a few months of good data, or by the fact that CPI inflation has come within the target range. They have to be also mindful of the risk of over-tightening, especially when large structural changes, geopolitical and geoeconomic shifts are taking place. On top of this, they have to be watchful of the risks from new shocks that could hit the economy from anywhere, anytime. We have now reached a stage when every action has to be thought through even more carefully to ensure overall macroeconomic and financial stability. More so because the conditions ahead could be fickle. We have to remain vigilant and ready to act as per the evolving outlook. India is better placed to withstand the uncertainties compared to many other countries. As the Indian economy trades the path, let me repeat, as the Indian economy trades the path to a brighter future, I recall the wise words of Mahatma Gandhi, and I quote, "Progress is absolutely assured whenever there is an unalterable determination." Thank you. Namaskar.
Okay. Well, you will have to say this is not a hawkish pause. I mean, there is no reiteration of OMO sales in any significant manner. Yes, there is a reiteration that the Reserve Bank will not rest till you get to, till CPI aligns to 4%. But my sense is that there are two very big positives in this policy. One, the growth forecast has been upped, not as expected to 6.7 or 8, but to 7%. My one eye was on the Nifty to see whether Mount 21,000 is conquered. It's still dithering at that point, but there is everything in this policy to just help the index over. Okay, there we are. As I speak, 21,000 scaled, and that's because a bit of a buck up is given by the Reserve Bank. Instead of sounding scared of the high growth and the potential inflation that it may lead, there was some fear in some quarters. There is no such extra fear over inflation that the Reserve Bank has expressed. It's also been more optimistic of growth than the average economist on the street. and the market is bucked up. The Reserve Bank is usually a conservative force. If the conservative force has taken GDP forecast to 7%, we ought to take it very seriously, and that's what the street is doing at this point in time. 21,000, I hope there are enough bells and whistles and flowers that our production team is ready with to celebrate this achievement, 21,000. But we have a policy to analyze. Ritu Singh is with me, and so are our guests, the Managing Director of State Bank of India, Mr. Sethi. We also have economists Kaushik Das and of Deutsche Bank and Upasana of Kotak. We also have Rajiv Radhakrishnan, the CIO at Fixed Income at SBI Mutual Fund. Mr. Sethi, let me first come to you. The governor has given a very optimistic forecast for growth itself. What are your key takeaways? Do you think you should expect higher credit growth this year?
Yeah, good morning, Lata. I think it is indeed an optimistic announcement, and I think there are quite a few positives, both in terms of the growth estimates, moderating inflation, though the governor sounded concerned on the vegetable inflation, which may, be higher. A few positives, both on the growth side and moderating inflation, and softening of the commodities, is also, I think, positive to economy, and the economic buoyancy is also visible in the second half. We hope that the growth rate in the loans will continue as we expected. This second half is generally a busy season for credit growth. The festive season, marriage season, they all spur the consumer spending, and we see the increased capacity utilization, as the governor mentioned in his speech. And hopefully we'll see definitely much larger credit growth in the system as well as in our bank. And a few other things also, of course, the measures which announced by the governor are extremely positive, Lata, in terms of making the reversal of liquidity facilities, both weekends and holidays. I think this long-standing demand from the industry, we are glad that it has been implemented, though it will be reviewed after 6 months based on, probably they would like to see how best it is being utilized. I think it's definitely eases the liquidity management at the banks and the financial institutions.
Okay. Actually, that was going to be my next question to you, Mr. Sethi. How do you think it will impact? If you will see, I mean, if banks are reassured that they can, pull out liquidity from SDF and MSF, or, extra liquidity even during the weekend, are you expecting that the call rates will come down? Is that a possibility?
Yeah, see, I think there is some amount of proactive borrowing which happens in the market, to take care of the weekend requirements. As you know, most of the RTGS, NEFT fund transfer is 24/7 now. And to take care of that, SDF is funded. The additional liquidity is mobilized over the in anticipation of the liquidity requirement for the weekends. That concern will not be available because we can always access the MSF now in case of requirement. And if any excess liquidity is there, that can be parked in SDF even during the weekends. I think it's a better management of liquidity which is going to be available to the banks, and it's extremely positive in my view.
Eased. Okay. Rajiv, what's your sense? Are we going to see any impact on the yields at all, especially shorter term yields?
Yeah, a lot depends upon how the RBI manages the interbank liquidity today, because over the last 2 months, even though the rates have the policy rate has remained at 6.5, the effective operating rate has been the MSF. So a lot depends on how that interbank liquidity evolves and where the overnight rates eventually settle down. So we don't really see any immediate visibility that the overnight rates are going to settle back closer to the repo rate. So to that extent, given that there is seasonality also involved, you could potentially see the shorter end of the money market curve staying elevated for a while. But yeah, finally, it depends upon where the effective operating rate settles down.
Okay. Got that. Upasana, I want your view on call rate as well, and near term, whether shorter term money gets cheaper, but more importantly, your reaction to the 7% GDP. Now do you think you're going to see a series of upgrades of GDP in the market?
Lata, we had recently revised up our GDP numbers to 6.8%. So we'll reserve any change at the moment. Of course, somewhere between 6.8 to 6.9 is where I was expecting RBI's number as well. So this is slightly higher than what we were expecting, but I think we'll have to wait and watch. We'll have to see how the high frequency data in the next quarter also pans out for us to have a much more firmer call for the fourth quarter. Third quarter clearly looks to be doing good. And if this was to continue, then probably RBI's readings will be we'll be closer to RBI's reading. So there was always an upside to the 6.8 that we were looking at, but we will wait and act based on the data that we get. On the call rates, I think we have to look at overall liquidity situation over the next 2 to 3 weeks. We have now the advanced taxes, then the GST related outflows. Yes, the government has been spending, but at the same time, we don't really expect liquidity to remain as benign as where it is, closer to neutral. It will tighten significantly in the next 2 weeks. The net impact of government spending will clearly determine how deficit it gets. So the rates, I think, will continue to remain closer to the upper end of the corridor for now. Next quarter is where we see scope for significant easing. It could be coming because of more government spending, and at the same time, also because of FPI flows picking up pace. Both of this could result in liquidity easing. And of course, what recently RBI has announced today, the MSF and the SDF related unwinding, I think that part is definitely positive, but we'll have to see how that really impacts markets on a more sustainable basis.
Kaushik, not at all the hawkish stance that some were expecting, the pause as expected. The GDP hike, almost 7%, I think nobody had factored in that. And I suppose the markets are going to be happy with the SDF and the MSF windows remaining open on weekdays and holidays.
So I think, Ritu, no surprise was the surprise element in this policy. Sometimes, it's good to have no surprises, and it came that way, so that's a good thing. I would like to make a few points. And the last paragraph, if you heard the last line, what Governor mentioned, one thing which he suggested was that, at this point of time, you have to be very careful with any kind of new announcement or decision, because, there is a risk of over-tightening as well, which could impact the economy. So this is the first time I'm hearing after a long time where RBI is trying to put a balanced narrative that, okay, we need to be vigilant. If inflation goes up, we need to be proactively, doing something. But at the same time, if we do too much, that can have impact on growth going forward. So that particular sentence caught my attention. And, we'll analyze that later, how to read that. If RBI has put a line like that in the statement, it has to have some meaning. So I think they're getting also a little bit cautious about the global turn that is happening in the market pricing for US and the Europe, advanced countries' interest rate expectations for 2024. So India also needs to be, aligned to that. So I guess the fear of incremental rate hikes have gone with inflation forecast remaining unchanged. The 7% forecast is looking a bit optimistic. It can happen, but remember that in February end, when we get the October-December GDP number, there'll be a host of revisions done to the previous quarter's data. So we have to analyze that and see how the base changes for the previous year. And we could achieve 7%. But then the narrative is, despite RBI's 300 basis points rate hike in this financial year, last financial year, this year there's hardly been any kind of, reduction in growth from 7.2. If you're achieving 7%, there has been no incremental slowdown to that extent. So then you'd expect those rate hikes to have impact going forward in FY25 and beyond. So RBI has given, probably 6.7 or something for next year, or 6.5. My guess is growth could be lower in the next financial year to 6.3 from if we achieve 7% this year.
Yeah, but like Lata was saying, RBI is one of the more conservative of the lot, and then giving the 7% number is quite the good news. But Mr. Sethi, coming back to you on this connected lending measure that the governor had announced, how do you read this? I mean, they're talking about coming out with a framework on connected lending for all regulated entities. And earlier, the governor had sounded a cautious note, on the NBFC, bank lending to NBFC, for banks to be watchful of, how much NBFCs are borrowing from all other banks. Do you think it's linked to that? Are you expecting stricter measures on that front? Or, what's your reading of these connected lending measures?
So let's wait and watch, Ritu. I mean, we'll have to see what is actually the coming out in that. But there is definitely a concern both in the regulator's mind as well as the banks in terms of the systemic risk which may come out if we do not strengthen our underwriting process, both at the bank levels as well as NBFC level, because there is so much dependence of NBFCs on the bank lending. And that continues to be one of the largest sectors to which banks currently lend. So it is important that both banks as well as NBFCs review their processes, underwriting standards, and the way we manage our credit. I think probably this could be the backdrop which earlier also was expressed and now would form the basis of the norms which are going to come out. I think we'll have to see what is there in the direction. And hopefully, I think probably it would be to address the concerns which are, leading to a kind of systemic risk if not addressed.
Mr. Sethi, so you think that loans could to NBFCs could already get rationed because of the very presence of these two words? I think Ritu is absolutely right. This is the most important thing that seems to have come on the regulatory side in terms of just a caution and a framework that is expected. Will you, in advance, lend less to NBFCs?
No, I think this is not about more or less lending to NBFCs. It is about, the way we lend to them, the assessment of the credit requirement of NBFCs. And more importantly, I think earlier the governor expressed, and as well as we also have been concerned that most of these NBFCs borrow from large number of banks. Probably that needs to be a little more cautiously looked at. Large number of lenders means, the monitoring standards probably get weakened. I think we have been saying that there should be a consolidation of number of lenders from where the NBFCs borrow, either NBFCs or MFIs. It is not to ration the credit available to them. Of course, the better managed and better governed NBFCs, MFIs will continue to get the credit support from the banks. I don't think it will lead to any rationing of the credit.
Okay. Well, we'll let you go, Mr. Sethi, to ponder over what they have said and touch base with you and other SBI officials later in the day. But certainly, this is something to watch out for in terms of a connected lending framework that's expected. Let me also get back to the economists on this very important point that Kaushik has brought, that the governor is also cautioned about possible over-tightening. And as he says, this is the first time in many policies that we have heard that. Upasana, your thoughts? And does this policy therefore qualify as a dovish pause?
Lata, two things. While I think the governor has very beautifully balanced the entire, guidance that they've provided for. One is their emphasis on inflation, 4% inflation being the goalpost. That they haven't deviated from. And at the same time, clearly, what they're emphasizing on is that somewhere over-tightening is, it may prove to be detrimental. So we'll have to be very cautious and agile. I think somewhere they've tried to balance the two things together. And that is important to keep in mind, because effectively, we have seen a stealth tightening of rates of quarter point because of very tight liquidity. And I think that is where we might see some moderation in rates coming down. So while repo rate remains where it is, we may see a small amount of next quarter onwards easing on the market rates, money market rates, somewhere a little lower than the MSF rates. And that in itself could set the floor overall for the next year. But I still believe that there is no point in discussing about a possibility of a rate cut anytime soon, because growth does remain robust and RBI is sounding extremely positive on that front. So I would still consider this as a fairly balanced policy, trying to evaluate on both sides more equally rather than taking it a step forward to say it's dovish.
Okay. Ritu?
Well, let me get back to you. Mr. Radhakrishnan, again, the liquidity-related measures, is there anything else that the markets are really watching out for? That threat of OMO bond sales, no mention of that at all in this policy again. In fact, the governor has said, the window will remain open on the weekends as well to facilitate easier liquidity. Was there anything else you were watching out for? I think, Mr. Radhakrishnan, you're on mute.
Yeah, sorry. Yeah. So the last two policy announcements, we did have certain unanticipated measures to address liquidity. So we had the ICRR, and then subsequently in the previous policy, you had the threat of OMOs. So I think this time the market was probably really looking at how the governor would address that OMO threat. And I think they have tried to give reasons as to why the OMO was not conducted over the last couple of months, because there was anyway a drawdown of liquidity due to seasonality as well as buildup of government balances. So that context remains, I think, going forward as well, because as you get into the next year, if we see large capital flows continuing, like in the last couple of months, we have again seen resumption of portfolio flows. So overall, the context is that RBI's actions on liquidity would be a function of to what extent the capital flows come in and to what extent that adds to interbank liquidity. So I think the single, going forward, what one needs to watch is from the operational perspective, would the RBI be comfortable running the system at 675, or as liquidity starts to come back at some point in the beginning of the year, would they allow the overnight rates to drift back towards 6.5? So I think that is something that probably would be necessary to watch incrementally. For the time being, yes, the immediate threat of OMOs, I think, has been...
Rajiv.
Yeah.
That was my question to you. Are you expecting a drift lower towards 6.5, going by the overall tone of what the governor is saying?
A bit premature. Honestly, no, I haven't got that sense, because I think it was quite balanced on both the sides, right? The governor did mention about the risk of over-tightening and again the risk of being swayed by a few months of good data. I believe we've not really got a very clear clarity as to whether they would allow the drift back towards 6.5.
All right. Okay, then we will leave it at that. Rajiv, thank you very much indeed for staying on with us through the policy. Kaushik, I wanted to ask you the same question that we asked Upasana, and the point you brought out. Would you say this is overall a dovish pause now, and therefore we can see some kind of relaxation of yields in the call market? See, they've spoken about this reversal of liquidity over in the weekend as well. They've spoken about higher dangers of higher tightening, over tightening. Does it prepare the ground for probably a neutral stance in the next policy?
So Lata, I would see it on the margin as a bit dovish, because if you had growth at 7%, forecast being raised, inflation, you're holding it at 5.4 on the margin, growth forecast has been raised, so you would have expected something more hawkish. So on balance, if you cut all the noise, and this sentence has been put in, RBI never will put a sentence without having any implication for the future. So I'm not saying rate cuts are going to happen anytime soon, but this is one way, the first time that they have put it, to bring in a bit of caution on the other side as well, that are we tightening too much, higher for longer? I'll just point out to you one thing, that in the last 20 years, the period between the end of a rate hike cycle and the start of a cut cycle, the maximum that RBI has held on to in 2 episodes have been 11 months. So the last rate hike was February. So by January, February, by that metric, RBI should be easing rates. This time the cycle is different, because the Fed is expected to cut a little longer than their own, peak of the rate hike cycle. So if they possibly cut in June or August, that will be more than 11 months, like 16 to 18 months. So keeping this rate higher for longer, will it impact growth? Maybe it didn't impact this year. We probably would be close to 7% like RBI has forecasted. But is there a risk for FY25? And monetary policy is always forward-looking. So you have to take a call right now, thinking about the next 3-4 quarters down the line, how credit growth will look, how general growth and inflation would look. So if you get a sense that not right now, but 4 quarters down the line, inflation would be close to 4% or between 4.5%, growth would be slowing down, credit growth would be slowing down because of the risk weights that have been raised. You have to start preparing the market slowly by putting in some sentence here and there. So I think that move has been made in this policy December. It doesn't change the big picture as of now, but going forward, incrementally more could be added if inflation comes down.
Okay, Mr. Ashwini Kumar Tiwari, Managing Director at State Bank of India, is also with us. Mr. Tiwari, thanks very much for joining us here. Your quick takeaways, liquidity management gets easier for you. How does life change? And what did you make of that connected lending framework that RBI is going to announce?
So the connected lending framework, Ritu, we'll have to see the actual details of what is there in that. But clearly, the RBI is a little worried about the same customer borrowing from banks, from NBFCs, from various other entities as well. And therefore, the need for a common regulation, or how do you track across? That's my sense. But I need to see the actual details of the announcement or the framework before I can comment in greater detail on that.
But Mr. Tiwari, do you think this is more linked to bank lending to NBFCs? That is something that the governor has pointed to before? Or is it more linked to the digital lending, which has also been heating up? So, what do you think he's referencing to?
I don't know for sure, because clearly the bank lending to NBFCs has gone up, which has been commented upon earlier, and the risk weights have also been increased. But the major issue in the bank lending to NBFCs and further NBFCs lending onwards is the monitoring of that lending, because most NBFCs are borrowing from a very large number of banks, even for small amounts, for 30, 40, 50 banks. And there is very little coordination which the NBFCs want between the banks to see whether the same set of assets are being shared across, etc. That is the difficult part. So as long as that part is controlled by any of the measures which is announced, I think that would be a good thing. However, I'm not very sure whether that is being referred to, or is it the NBFC lending to, or digital lending referred to. I'm not sure.
Okay, so Mr. Tiwari, thank you for joining us. Would you say the overall impact will be, what the governor said is that they're going to put out a framework for this connected lending. Until that comes, is there a likelihood that all of you will slow down a bit on both NBFC and unsecured loans?
So there is no question of as such slowing down or something. We are cognizant of the risk weights which have been increased earlier and the impact that has in terms of rates. And the important thing is that all banks should have internal limits, as we do, on how much we will lend to NBFCs, how much unsecured lending will there be. And as long as we are within those caps, and as long as the overall quality of that lending stays good, I don't think we are going to slow down. For good quality credit, whether it's the NBFCs or otherwise, or in unsecured, in our case, it is largely salary driven. I don't think we are going to stop or slow down, etc. We will be cognizant of the risk as they are and recognize them.
If you were an NBFC, how would you read this statement? I mean, we will get NBFC companies later on in the show, but would you say that the governor is just raising the bar a little more in terms of the availability of loans for them?
As an NBFC, I'm already worried because of the previous announcements which have been made. So I would like to read this first in detail, because clearly if the cost of credit goes up for the NBFCs, and further tightening happens in any manner, that would make it difficult for them to get funding cheaply and pass it on to the other segments which they are lending to. But clearly the growth shows that the economy has a lot of capacity now to absorb credit. And the RBI's endeavor, I think, is only to make sure that it is graded and it is in a calibrated manner, not in a spurt or a peak, which is what they want to control. So we'll see about the details of the announcement and then take a call.
Mr. Tiwari, if it helps, let me just read, because now the speech is on the website. So I can read out that line to you if it is any clearer. The extent guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by regulated entities. Is it sounding like strict?
So see, the connected lending guidelines, as mentioned, were already in place. As far as what tightening will they make it or what clarity they will bring, as I said, we have to look at the actual policy framework when it comes out. I really can't speculate on the governor's words as to what he means unless I look at the details of it.
Yeah. No, we will of course have occasion to ask him in the press conference what exactly this means, and maybe we will get more clarity over there. But overall, have rate hikes been passed on, or do you think there is a little more? I mean, if I'm a home loan buyer, should I be prepared for a little more in terms of rate hike, or have we peaked?
No, I don't think any more increase in rate hikes is being considered by us at all. Of course, on the corporate side, there is always this competition which happens and which kind of brings down the overall rates for people. But from a lower base earlier, prior to the rate hikes, that has also gone up. So in that sense, the linkage to the monetary transmission, which the governor also mentioned, has happened. I don't see any further increases either in home loans or any other products which we have, except for the risk weights which were increased some time back, where some increase might happen. Other than that, I don't see anything happening in the terms of rate hikes.
Oh, okay. Well, actually, as of now, the bond yields have gone down a bit. It was 7.24 when the governor finished his speech, and now it is 7.23 on the 10-year. So clearly, the market is reading this as positive. The markets have sulked a bit. I was expecting 21,000 and more gangbusters because of the Reserve Bank backing that 7% number. That has not happened. Mr. Tiwari, thank you very much, sir, for joining us with your first thoughts. So we will get back to the SBI biggies after the press conference as well. Upasana, I wanted to ask you the same question I asked Kaushik. You know, the overall impression seems to be that the Reserve Bank is done with tightening. No, once again, brandishing of OMO. In fact, a statement that we must not go to the risk of over-tightening, and a very big revision in growth as well, better than all the markets. So is this a dovish policy? Would that be your statement?
Lata, I'll again say I'm not treating this as really dovish. A more balanced word is what I'll go with. I think...
Hello, I can't hear. Can't hear. Here.
If I was to read the resolution, am I audible, Lata?
Yes, now I can. Go ahead, please.
Yeah, so if I just read the resolution's last paragraph, that is nowhere sounding any soft. It is actually balancing it out and talking about their focus on 4% being retained, and they have to ensure that the disinflationary trends are sustained. Also, when we talk about the withdrawal of accommodation stance being changed, because clearly nobody is really expecting a rate cut in the near term. I think that's one thing we have to be clear on. The only change that could come about at any point in time is about the drop in the stance that at the moment what they have. And that too, I don't see that happen before probably the middle of next year. The reason I'm saying is because inflation is still a problem. And till that doesn't happen, while no more tightening has to happen, but no more easing is also required. So I think they'll still continue to be on a balanced footing rather than dovish, because that will probably undo the kind of efforts that they have taken over the last few months.
Okay, got that. The absolute middle-of-the-road policy, neither hawkish nor dovish is your statement. And I think that statement has to be read that way. Policymakers have to be mindful of the risk of being carried away by a few months of good data, or by the fact that CPI inflation is coming within target range. They also have to be mindful of the risk of over-tightening. If you read it together, then perhaps it looks more middle of the round. But the fact that for the first time he's speaking of over-tightening is a bit positive if you are a dove. Thank you very much, Kaushik, Upasana, Rajiv Radhakrishnan, Mr. Tiwari, for reading the fine print of the policy to us. Thank you very much, Ritu Singh, as well. The statement, the big takeaway from the governor's policy is that growth has been given a kind of a leg up by a conservative entity like the Reserve Bank, saying that this year's growth is going to be 7%. If I remember right, Shaumikanti Ghosh of SBI is the only one on the street with a growth forecast of 7%. Everyone is in the 6.7, 6.8 range. So this should be seen as, extremely bullish on that count. The bearish element, or maybe the cautious element, is only this word on connected lending and the fact that some overarching framework will come out from the Reserve Bank. Will that make it a little more difficult for banks and NBFCs to lend to unsecured quarters? We will have to see, because that has macro implications if there is lesser unsecured loans and lesser money going to the NBFCs. But that will depend on the fine print, and it will also depend on what the governor tells us. Otherwise, it looks like a very neutral pause by the Reserve Bank, neither this way or that, and the bond markets have reacted with bullishness. You have actually seen bond prices rise. On that note, thank you very much for watching this special edition of the Monetary Policy. We will be back with the governor's press conference.